broadly aware of the well, what we're calling the crisis in the energy sector, the volatility of prices, the record high prices, and the politically unacceptable impact this has had on households, but also on industry, whether that's big energy intensive industries or small and medium enterprises. So overall, there was a strong political sense that even if these were market signals coming from a functioning market, they weren't particularly tolerable, and we needed to do something about it. Next slide, please. So, as Shimon mentioned, all of this grows out of a broader energy and climate framework. We've got the Green Deal. We came forward with Repower EU to basically try to speed up elements of the Green Deal and to cushion the impact of the prices, and to immediately start reducing our dependence on Russian energy. And then in addition to that, there were the emergency measures. So we took emergency measures to dampen dampen demand, and reduce demand both on the gas consumption side, where we feel we were very successful. We had a year-on-year gas reduction of consumption of almost 20%, which is one reason why the Commission's proposing to extend the measures to reduce demand for gas. We've had similar targets and reductions on electricity side, both a broad one and then a targeted reduction of electricity consumption of 5%. And then we've been running around the world buying gas to diversify our sources away from Russia. And that's had a very big impact as well, with importing record levels, particularly from the US, of LNG. So a lot's been going on. These have been the temporary measures, the funding measures. And as Shimon said, we're now taking what we feel we need to do for the more structural elements of the electricity market, and making those fit for the future. And the way we've been presenting it, as I put up here, as in terms of firstly addressing the crisis from the consumer's perspective, where they've faced excessively high prices, excessive volatility, and trying to take measures to reduce that. But then we also look at the way the energy market itself has been impacted by the volatility on short-term prices. And the general impression is that we built up a very well-functioning short-term market, but neglected slightly the longer-term market. It wasn't particularly appealing or interesting for a lot of investors. So that's why we're now turning our attention to longer-term contracts. And fundamentally, to drive gas out of our energy mix and to drive gas prices away, or less influential in terms of setting energy prices, we want to do more to bring in renewables, which includes also bringing greater flexibility into the short-term market. And then there's a last bit where we're also improving the way regulators monitor and survey the market to ensure that it's functioning competitively. So those are that's the political orientation of our story, if you like. I'll go into a bit of detail on all of that, and then we can come back to your particular perspective in terms of interest, whether that's the impact on risk is an important one, so we can bring up that afterwards. Next slide, please. So firstly, we're looking at the perspective from the consumer, and we're just defining this in two terms, in terms of the protection that's needed and the empowerment that's needed. So to look at some of the protections, firstly, we flag up, and this is the way I'm presenting it this morning. We'll talk about what we currently saw as the problem and what we are proposing in the legislation. The legislation being either the electricity market regulation, or in some aspects, particularly the consumer aspects, the electricity market directive. But I guess from our perspective, what matters is what we're actually going to change. So firstly, there are several countries where households faced dynamic pricing. They didn't have long-term contracts, or they didn't, even if they had a long-term contract, the prices weren't fixed. And they were immediately exposed to the shockingly high prices from the short-term market. And that's something that there's a political sense, shouldn't have been obligatory. So now we're switching to a requirement that consumers have a right to a fixed price contract. We're not determining the price of this, so that will still be for suppliers to determine, but the option of this as a product is going to be obligatory. The other aspect that we saw in the suppliers' side during the crisis was the fact that there wasn't much interest in hedging, and now this is partly because of the different inadequacies and lack of liquidity in longer term markets, but it was a general sense it wasn't particularly necessary. There was a broad sense that in general electricity prices are coming down. We were more worried about negative prices on the short term market than shockingly high prices. So that meant there was an under investment, if you like, in hedging. And so now there'll be an obligation on suppliers that will require them to have some hedging, to explore the hedging products, to build up liquidity in the hedging markets. And I'll get into what those are in a moment, depending on their particular portfolio. So it will need to match their portfolio, but that will be a new obligation. And both of these are a way of providing more stability for prices for consumers. We're also planning to broaden the choice of contracts available to consumers. One particular aspect of this is that, well, we generally in our houses, if we're lucky to have a choice of the supplier at all, we don't get a choice to have multiple suppliers. Whereas if we're having very different types of consumption patterns, then we would like this. And the classic examples are if we have a heat pump where we could contribute demand response in a tight market, or if we did have an EV and similarly we could provide demand response, then that would warrant a separate meter, a separate contract. And in this ideal world, we provide variability and capture low prices as a consumer by offering this variability if we've got heat pumps and EVs. But then if we need more stable levels of consumption, then we pay a fixed price for that. So that's the image that we have here in terms of developing the right to have multiple contracts. And then we're also requiring that there be better information provided by suppliers, and that member states set up, this is indeed for a crisis situation, we just want them to set up the regime for suppliers of last resort, because this caused a degree of chaos in certain countries over the last couple of years where it was all a bit taken by surprise. And then again, if we are to face a crisis again, then there would be a special regime for regulating retail prices in the event of the crisis. So those are the measures that we're putting forward from the consumer's perspective. Next slide, please. And now turning to the broader impact of volatile prices insofar as they affect competitiveness and EU industry. This is where we basically tell our story of developing longer-term products for longer-term markets. And these are power purchase agreements, contracts for difference, which are government-provided long-term contracts, and improving the way the forward markets work. So in terms of power purchase agreements, PPAs, these should be a good long-term market, but they are fairly illiquid in most member states, and there's certainly little trading across member states. So these are ripe for improvement and growth. And we plan to do this in a number of ways. Firstly, one of the main barriers to even development within a member state has been the creditworthiness of off-takers. It's fine if you're a Google or a Microsoft, and banks are fine with 10, 15-year agreements with them. But there are a lot of smaller players who don't have that kind of creditworthiness, and there isn't the insurance market or the credit guarantee market to support them in such long-term contracts. So we're requiring member states to ensure that such an insurance market or a guarantee market does exist to facilitate creditworthy enterprises being able to take up these long-term contracts. So that's the first thing we're doing. We are also encouraging the use of PPAs by saying that, well, if a government is offering a contract for difference, a public subsidy, then as part of its offer, when it does a call for an auction to take part in a CFD, then it could give an incentive or flag up an interest in having a project apply which is both a PPA and wanting a CFD. Now this would, if this project came through, then that's government getting a bit more for its money, if you like, and it's also an incentive to grow the PPA market. So it's a mutual sharing of risk there. Then when it comes to the CFDs themselves, the contracts for difference, I don't know if you're all particularly familiar with these. These are long-term contracts offered by governments, and in general, they've provided a premium on market prices. But what we're requiring now that we do face the prospect of possibly high energy prices on the short-term market is that instead of just a floor for a contract for difference, there should be a ceiling as well. So that's why they're two-way contracts for difference. So if from the investor's perspective, the investor enjoys these contracts because they're getting a minimum return. So there's a floor price that they are guaranteed irrespective of what the market's doing. Now that there will also be a requirement to have a ceiling such that if market prices are actually above the ceiling, then they would actually be paid back to the government to compensate. So an investor would get public support in the event of low prices, but he would pay back the surplus in the event of very high prices. And then there's an obligation on member states to use such revenues when in such circumstances to compensate consumers. So that's the regime that we're establishing for contracts for difference. And then on the forward market side, again, there's been no particular growth. These have been dominated in one or two member states, no cross-border trade, fairly limited in duration. So again, we want this market to grow. We're doing that partly with the plan to create a regional reference price and via a hub. And we're also going to require TSOs to allow greater auctioning of cross-zonal capacity for longer than a year, for up to 3 years at the moment, so that you can have because at the moment, if you have a forward contract, you still have the risk that you have to buy cross-border capacity on an interconnector each year. So that will change. So those are the elements we're taking to grow the different types of products that are available in the longer term markets. Next slide, please. And then we're talking about renewables, boosting renewables. As Shimon mentioned, the target is around about 69% of our electricity mix by 2030, and that's major growth. So everything that we've been doing to speed things up is needed at double the pace. And we can address this, we think, by trying to bring down some of the price uncertainty and the volatility that investors have faced over the last couple of years. So partly we do this with all the long-term contracts that I've just outlined. We hope these will have an impact in terms of providing more stable revenues that should be reassuring to financiers and bankers such as yourselves, and bring down the cost of capital. That's the broad logic of it all. But another dimension to bringing renewables into the electricity system is the vastly expanded need for flexibility and the inadequacy of the system at the moment in terms of providing the right incentives or sufficient incentives or reducing the barriers to bring on this flexibility, in particular demand response and storage. The needs are huge, but these are novel products, they're novel business models, and it's all a bit too much in some cases for regulators, or in some cases just for the infant market to develop. So to boost this, we're requiring member states to put out a formal assessment of their need for power system flexibility. And they develop this in the context of their energy and climate plans, in terms of their 10-year network development plans, and they discuss it with the ENSOs and the regulators. And on the basis of that needs assessment, they produce a report, and they can set an objective. Again, just to give the broader stakeholders in the energy sector, such as yourselves, a sense that yes, this is a market that's going to grow. Here's a government objective, and we're also establishing a regime where they can provide explicit extra support for demand response and storage. And then finally, in terms of boosting renewables, we're improving the way the intraday market works. At the moment, again, we're talking novel products, difficult variable products, which are not what traditional monopolistic operators and regulatory regimes are made for. So here we're going to provide the obligation to open up the market for trades closer to closure time. I don't know if you're familiar with the term of gate closure, but it's the concept that if the closer a power supplier can make his bid to real time, the more accurate it is for a wind supplier or a solar supplier. So if they can make their bid and have an accurate offer within 1 hour of real time, or within half an hour of real time, or within 15 minutes of real time, then their bid is more accurate, and the expensive imbalance costs of compensating for any uncertainty are reduced. So that will make it easier for wind and solar suppliers to bid into market more accurately and lower the system costs. So those are different ways we're trying to facilitate the even greater acceleration in the growth of renewables into the electricity sector. Next slide, please. So those were the three different dimensions that we give to the political narrative to hold this reform: the consumer perspective, the long-term industrial perspective, and the boosting renewables perspective. Now I'll just jump into a bit more detail on the long-term instruments that we've been talking about, because that's, I guess, these are what's particularly of interest today. These are the tools that we think are going to have a role in reducing volatility, boosting revenues, reliability, which is what's important from a financial perspective in terms of stabilizing revenues. So here, it's a bit of background on what a PPA actually is and where they've actually been growing. I think the key point is that these are a private sector instrument. They're available there, but it's currently quite a small market, and it's really only the large companies that are using them at the moment. So with that kind of background, that's and as I mentioned before, this is why we want to build up the creditworthiness regime behind all of this, because if we can take small measures to improve even a market, or just a market-based guarantee regime for such a sector, then that we would hope will grow the sector and keep effectively a private sector, a private managed, privately driven market growing. Next slide, please. Then in terms of what I've just been saying some of this because I forgot I had this slide here. So we're trying to reduce the additional barriers of SMEs, reduce their risk, reduce the high transaction costs associated with developing these products. As the liquidity grows for the product, we would expect a degree of greater standardization, which would also help make the product easier to grow and to be for smaller players to be aware of. So that we're not intending ourselves to be standardizing anything, but as these private initiatives grow, they would become a bit clearer, and the market would become a bit more standardized in itself. Next slide, please. Then on the CFD side, as I said, the key aspect of what we're proposing is the obligatory use of two-way CFDs with floors and ceilings. But in other respects, I guess you're pretty familiar with the way these instruments work. They're fundamentally a price floor protecting investors from excessively low prices, so that investors should have a reasonable return to cover their average costs. Now we're saying that we want them to have a reasonable return to cover their average costs, but not an excessive return, as they may have enjoyed over the last year. And when those returns are excessive, then they actually have to have the other side of the coin and pay back some of their extra revenues to the government. And these are just illustrating, if you can see this on your screens, the growth that we've had in the two-way CFDs. They did at one point reach just over 50%, but so they'll be growing in the future. Next slide, please. And then lastly, on the forward market, again, I mentioned we're creating a virtual hub to grow this market, and in particular requiring the access to multi-annual capacity rights and auctions. So with that, we trust that the forward market will grow. It will grow within individual member states, but also improve the capacity for cross-border growth. And again, as we're now aware that we do need more hedging, we do need forward markets, we do need longer-term contracts to ensure against horrendous price spikes, then we would expect these markets to grow, and we'll be doing what we can from the regulatory perspective to foster that. Okay, I think that's it. Next slide, please. No, I'm still talking. More background on the flexibility. I think I've said all of this actually. So our main targets are demand response and storage. There's been low participation. System operators themselves are still getting used to the idea and to work out what the right incentives are. Perhaps one thing to flag up, there's two dimensions to it. One is we're talking of a specific peak shaving product, and this is something that a system operator would develop as a product within its own, for its own management of the intraday market and the balancing market, and that's different from the broader flexibility regime we want to encourage in the short-term market per se, which would be developing private instruments for demand response and storage to be offered as normal products in the short-term market, not purely as ancillary services in the context of a balancing market. So those are two different approaches and instruments that we're planning to develop. And I think that is my final slide. But if not, I've talked too long anyway, so I'll leave it there. Oh dear, I just have more. Here's some more detail. But I think I've covered all of this. Thank you. Yes. There we are. And I'm happy to take any questions. Thank you.
Thank you very much, Tom, for your presentation. I would like now to pass the floor to my colleague Baptiste Bouet for the moderation of the on-spot reaction section.